All right, everybody. How you doing? Good evening. I appreciate you all coming out. My name is Ronald Madlock with MF Financial, part of the Recession Proof Family. I had to rock it. I was just telling Tiffany, I just got my T-shirt in today. I'm really excited about it, and I appreciate you all coming along and joining me here. And I think about this information, just like the information that Marcus tells us and everybody tells us, and Marcus says at the beginning of all of our presentations and webinars, the information I'm giving is not just for you to benefit, but for other people to benefit. So that is definitely what infinite banking is about. That's definitely what my company, MF Financial, is about. How many more people can we touch? How many more people can benefit from what we know? Um, so I appreciate you all coming. Like I said, this is a last minute thing because things people had a lot of questions after our webinar the other day. So I appreciate you guys logged in. And again, a this will be recorded. So I will make it available to everybody. I'm going to put my contact information in the chat. What I want you to do is, if you want a link to the recording, reach out to me. I'm the best through email, so reach out to me through email. Let me know that you want a link to the recording, so we can go from there. So I want to start. I'm gonna pull up this presentation. We're gonna start right there. So so good evening again, everybody. Welcome. My name is Ronald Madlock with MF Financial, and this is the special recession proof edition. I am going to go through some overall information about infinite banking. What is it? How can it be applied? How can you benefit? Right? So, got a lot of people coming in. All right. So, we always try to start with a problem, right? This is a solution to an issue. And, one of the things that we're learning in recession proof is what? There's issues out there. There's things that we thought um, is how things worked, and how you have to set this up, and how you have to take this path to money, to credit, to wealth. And we've been learning throughout our uh, our journey with recession proof that that's just not true, right? It What we think it is and what people say it is, it's just not true. We've been able to learn so much. We've been able to learn shortcuts and the specifics on how to make ourselves better, and how to to get to our destination and our journey faster, sooner rather than later. So, what is the big problem, right? And the biggest problem is we don't realize that no matter what, we finance everything we buy. And it's somebody getting that interest. And most of the time, that's not us. Most of the time, it is not us. Whether we pay with a credit card, that's interest, right? So we have constantly money going outside of our family, outside of our own personal financial system. That is the biggest problem that we have. And I think the problem above that is what? We don't even realize it. We don't even realize it. We're so used to, if I want to go get a car, I go out and I just get a loan for it. That's just what people do. Or if I want to, buy all this stuff for Christmas, if I want to uh, buy that furniture for the house, all these other things, we're so used to going outside of ourselves, outside of our family, outside of our personal network. in order to receive funding for the things that we want to buy. That is our biggest issue, right? And these are some wise words from Albert Einstein, right? You carry around the knowledge that everything that you buy is not only costing you the face value of the product, but also what you could have earned with that money for the rest of your life, right? Think about that. It's not just the interest today, it's what else we could have done with that money throughout the process. We're missing out on that opportunity when we have our money go outside of our own personal system that we created ourselves. And that's just the truth. If you don't have it in your pocket, or it's not, in your family, it's in somebody else's pocket. When we need to figure out how to recapture that. And that's why, what drew me to this opportunity, what drew me to infinite banking, is because I want to create a structure that will build a family legacy. That's number one. That's number one, a family legacy. Everything that we do is about our last name, right? Not our first name, but our last name. Why? Why would I want to gain everything, but the generations that come behind me don't have anything? I can live well, but they'll have nothing. I'd rather secure that generation's legacy while I'm still alive, before they start living their life. And this is an opportunity to do it, not only through the process, but also through the instrument. And the goal of that is to teach yourself and to learn how to turn every loss into a gain. That is my goal. With infinite banking, the goal of infinite banking is to turn every loss into gain. That money that would be going outside of your system, those people that would be gaining interest on the money that you are spending, you become that person. You become your own bank. Right? And just like our credit journey, right? Just like our credit journey that we had to go on to be successful through Recession Proof, just like that, we have to do the same exact thing when we're talking about, our journey with infinite banking. You have to be honest with yourself. Who are you, right? Who are you? Are you the debtor? Are you the debtor? The person has no savings. I mean, some of us, we went through that. We're working on that. Some of our customers are those people, right? They never have any savings. They don't have any type of assets. They're constantly buying, but you know what? They look good. They look good. They go everywhere, and they have everything that's the latest, right? They're constantly borrowing money, whether it's from you. Come on now. Come on now. I'm not the only person. I'm not the only person that went to the mall and saw their friend in some brand new tennis shoes when they owe you $20. I'm not the only person. I can't be the only person that somebody owes you money, but they looking good, right? So again, are you this person, right? Are you that person? Are you the debtor? Are you the saver? Are you that person that's like, you know what? I have money. I'm not paying for anything. I'm not getting a loan. I'm not using credit cards. The issue with that, because it's a great thing, first of all, having a savings mindset is a great beginning to your financial journey, because at least you are thinking and you are having money for the future, and you're able to deny yourself momentarily for something in the future, right? Because, we all get caught up in instant gratification, right? That's why I was a little too excited. I was like, where's my shirt? Where's my shirt? Where's my recession proof shirt? Because I wanted it. I wanted it now. I'm scrolling through Instagram, people wearing it, on our calls and our webinars. But again, I have to show that patience, right? We have to show that patience, and we have to do that in the financial arena. But the only issue when it comes to those savers, because this was me, for instance, I'll take me as an example. I've never gotten a car loan. I've only said, okay, how much is that car? Then I'll work and work and work, and I'll save and save and sacrifice and save. And then I'll finally buy a car. Right? Am I the only one? If you've ever done this, if you've been that person that you just save and save and save, and then you make that big purchase. Come on, somebody give me a one. Some ones in the chat. Who's that saver? Who's that saver? That likes to, save up a whole lot of money, then they drop it on the purchase. Who is that saver? Who's that saver? There we go. All right. You a saver, Mr. Brown. Who else is a saver? Mr. Brown is a saver. Who else? Drop that money. And you know what? That's a great thing. But the only issue with that is once you make that purchase, all your money is gone. All your money is gone from there. So that means that you have to start all the way over. And it keeps happening over and over and over. You start saving your money for that big purchase, then you purchase it, then you're back at zero. Now, I don't know about you, but when I'm saving, I love looking at that account. I love looking at that account when I'm a saver, when I'm saving it up for something. But when it's gone, it's a heartbreaker because I know I have to start all the way over again from zero. But it draws me to this. What is an infinite banking account, right? Because infinite banking account, its purpose is to alleviate that issue. Its purpose is to stop you from saving. You drop the money, and then now you have no other capital left, and all you have is the item that you bought. Okay, so an infinite banking account is created through a high cash value, whole life dividend producing policy, right? Through a life insurance policy. And the infinite banking policy is not an investment. It is more like a high interest saving account. And I'm going to say that because the way that I practice infinite banking, what's important to me, I don't know, you tell me, is high risk, high reward more important to you, or is it guarantees? Like things are guaranteed. You tell me, please. Somebody drop me in the chat. Are you guarantee or are you high risk, high reward? Which one is more important to you? Y'all tell me what's more important to you. Give me a one if you want guarantees. Give me a one if you want guarantees in the chat. That's right. Okay. Guarantees. That's right. Guarantees. Absolutely. You can do absolutely. And I'm glad you said that, Mr. Brown. I'm seeing the ones, we seeing guarantees. Absolutely. Absolutely. And you know what? I'm glad, Mr. Brown, I'm glad you said both. It does allow you to do both. But it's a process on when you do that. You can invest, but it's a process. You put it in your infinite banking account first, and then you go from there. Right? Because like I said, it's you should be thought of as a high interest savings account. And once your money is in that account, you can do what you want with it later. But we want that foundation there, right? We want to build that foundation. Now, a lot of people, and it's the way you want to do. A lot of people like to go the IUL route, which is fine. The index universal life insurance policy, and that's fine. They usually come with like a higher interest rate. But what I don't enjoy about it is that it doesn't have as many guarantees as the way I do it. And as we said, if guarantee is the most important thing, because in any house, the foundation is important. The walls can be beautiful. You can have a beautiful new roof. The windows can be, triple pane and all that type of stuff. But if the foundation of that house is not right, it's going to come crashing down. So let infinite banking, your infinite banking account, be your foundation that you can build everything else on top of. And that's what I do. And that's what I teach others to do. So again, why do I go this route? Why do I teach people to go this route? Why? Because what we do is a consistent return. It grows tax-free. You can distribute it tax-free. You have easy access to your cash value. You have guaranteed values. You'll know every year how much money you'll have in your infinite banking account. And my most important part of this, I have complete control over it. I let people know where my money goes. I can pull it out when I want to. I control how much I'm able to put into the account, how much comes out of the account. I'm in control of all of that. And let me say this before I go any further. A life insurance policy on its foundational level is something to secure in case of future disaster, right? It's to secure your family, your heirs, the generations that come after you at the simple level, at the foundational level. That's what it does. That's what it is. So again, a lot of people I speak to, they're like, look, well, I have coverage, right? Well, let me ask you all, are you covered? If you're covered, put a 1 in the chat. If you're not, if you feel like you're not covered so far as life insurance, put a 2 in the chat, please. If you feel like you're covered, put a 1. If you feel like you're covered, put a 1. If you feel like you're covered, you say, man, I'm good. My family's good. I'm covered. We're good. We're good. Yeah, put me some 1s in the chat. Okay. So 1s. Okay, I'm seeing some 1s. But let me walk you through. Let me walk you through this before we go on. Because again, we're about building legacy here. That's what we do. That's why we're in Recession Proof. We're trying to change the trajectory of not only ourselves, but our families and other people's families too. So since a lot of people say, hey man, I'm covered. Let me ask you this. With your coverage, is it at least what your salary is per year? That's just the first part of the question. So again, on a foundational level of life insurance, you want to be able to cover your family. Your family should be covered as if you weren't there, right? So if you make 70,000 and your life insurance policy is only 50, are you covered? Okay. Now let's just talk about that. Then on the back end of that, let me ask you another question. With the debts, because I know a lot of us are entrepreneurs. We have businesses, we have property, we have what else? We have business, we have property. We're doing manufacturing spending with our business credit cards and all those type of things, right? So when you think about all the things that you owe, all the loans that you may have out there, let me ask yourself, if I was to pass today with what life insurance coverage I currently have, could my family take that money and be able to wipe out all of those debts and them not be affected at all? Ask yourself that. So I'll bring it back around to the question to the group. With just those scenarios that I laid out, do you still feel that you're covered? Do you still feel that you're covered? I want you to ask yourself that. Or am I still covered? Okay. So let me move on to the next one. Average rate of return. And I'll put this up because of two things. Again, I'll say it again. This is not it's not an investment, right? Infinite banking is a process. It's not an investment. And I said it's more likened to a high interest rate savings account, right? So what I did, I just did something simple, and I just put it side by side. So on the left hand side, I got a savings account. And on the right side, I put together a infinite banking policy, right? And these kind of the numbers, right? And if you look on the left hand side, you're like, hey man, savings account has making 1%. Me right now, I don't have an account making 1%. That's automatic every month. I don't know what's the highest savings rate I have right now. Somebody got over 1%. Who got over 1%? Anybody got over 1% in the chat? Let me know what you got. Got anything over 1%? Because I haven't seen it. Ever since they cut the interest rates, things have gone down, 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 even less. A fraction of 1% is what most people are getting. A fraction of 1%. But anyway, let me go through these charts. So basically on the left hand side, you can tell, hey, you're killing it, right? You're killing it so far as in that first year, you have more cash value, right? You have more cash value for a while. You have more cash value for a while. But then you take a look over on the infinite banking IBC side, you have a cash value. But another thing that people forget about is that you have a cash value plus the death benefit. Now, if in the first year you deposited $2,000, that's cool. Your family gets that $2,000 out of your savings account, right? That's cool. That's no problem. But if you died in the first year having this policy, your family gets 70. Now, I don't know about you, but I'd rather my family get 70 than 2,000, right? I put in the same amount of money, $2,000, but it got me something different. So I put in $2,000. It not only gave me a cash value, but then it gave me a death benefit as well that my family gets automatically when I die. And if you're paying attention to this, to the death benefit side, it keeps going up. As your cash value goes up, and as the time goes along in a policy, your cash value increases. It increases and increases and increases. And I want to show you something else as well. I want to look at year 20. I want you to look at year 20 just for a second. So over these 20 years, you've put in $40,000 worth of deposits. But how do you have $41,000 worth of cash value there that you can use? Because that money inside of your cash value in your policy, it grows at a guaranteed rate. Again, we're going back to guarantees. It grows at a guaranteed rate. And every time you make a deposit, quote unquote, pay your premium, that cash value grows. So that means the amount of interest added grows. And also your death benefit grows. Now in 20 years, again, you went from your family getting 70,000 to 170,000 worth of cash value, worth of death benefit. Okay, let's keep going. Let's keep it going. So, I always run into this. Like people are always like, man, if this thing is so great, like, why don't everybody do it? Who else do it? Who else do it? All of these people do it. All of these people you see on the screen, have a strong insurance beginning, infinite banking beginning, and a strong just insurance investment. Walt Disney. I mean, everybody knows the story. Disney World. No bank was going to give him money to invest in a swampland in Florida. So what did he do? He took the money out of his infinite banking account. Well, his policy, his life insurance policy, and he put down on that. And he was able. I mean, look at Disney World. I mean, look at that. Look at the legacy that. I mean, it's his own town. They have their own money. They have their own rules. I even heard they have their own like security team or like pseudo police. Come on. Walmart. I don't know if you all remember, but a few years ago, they literally have, I'm gonna tell you guys this. I'm gonna tell you all this. If you guys don't remember, they literally have Walmart insurance rules now. Literally. Why? We're all entrepreneurs out here, right? We're all entrepreneurs. We have partners and also we have employees. Okay. Let me tell you this. If you have a partner, if you're partnered with somebody, you can go, hey, if it, it's all contractual, you all did it the proper way, you can get an insurance policy out on your partner. Why? You guys have a financial obligation to one another, right? You guys have, a financial entanglement together, right? So if something happens to that person, that's the other half of your business. You need to be covered. But where the employees come into play and when you get into the Walmart rules, because what was Walmart doing? Every single employee, they were getting life insurance policies out on. I don't care if you're a greeter, a bagger, a stocker, or anything. And they were getting these life insurance policies out on them. And when these people would die, they were just collecting, right? And remember, when you collect on a death benefit, that's tax-free. And they got in trouble because, they had, all this money, they were collecting all this money, they weren't paying the people's family. Like even people that had quit like years ago, they kept paying the policy premiums. They're literally Walmart insurance rules out there because of that, because they took advantage of how beneficial this is. What else? Okay. Bank-owned life insurance. So what people don't realize is that the biggest contributors to life insurance are banks. Wow. You like that doesn't make any sense. I put my Instagram inside of the chat. Check out my Instagram and I'll show you the FDIC filings from the top 20 banks, how much they have worth of stocks and how much they have of their own money into life insurance. It's on average like 10 to 1. They might have $2 million worth of stocks on their books, them personally own, but $20 million worth of life insurance. Again, those are rough numbers, but it's like 10 to 1. Why? Unfortunately, we don't get all the benefits that a bank has because a lot of us aren't billionaires. But they have the advantage that when they put down $10 million on a policy, they get $10 million worth of cash value. And it's like, what did I tell you before? It grows at a guaranteed rate. They have all the controls, so that means that they can take out the cash value whenever they feel like it. And just like anything with a bank, it comes to you in 3 to 5 business days. Just like everything else, any type of transfer. It's growing at a guaranteed rate. If somebody dies, if the person that's covered dies, they get that money in tax free. Oh, it grows into cash value tax free. Okay. Also, the life insurance policy with the cash value is safe from creditors. That's right. It's safe from creditors. So again, if everything falls down and hits the fan for them, guess what? Boom. They still have their cash value in their life insurance policy. So not only do these banks have policies, they are the biggest contributors to these policies. Okay, this is just a brief overview of how fractional banking works. Now, see, this, infinite banking is a great setup, but like I said again, banks themselves, they have a great setup. And I ask people this, where do banks get their money from? Please, somebody tell me in the chat, where do banks get their money? In the chat, where do banks get their money? Where do banks get their money? They always have it. They always have, the nice big buildings, nice clean lobby, marble floors, windows, all that type of stuff. Okay. We got a couple of answers in the chat. The biggest contributor, the biggest place that that banks get their money from are us, from our deposits. Think about it. Our deposits give them the money to loan out to other people. They don't have any money. A bank is basically a building that's like considered security. Like you basically like paying them to secure your money. Because think about it. If we didn't put money in, how could they loan it out? They don't have any deposits. So how do they make money? People are like, look, so how do they make money? I'm about to show you in this diagram. Okay, so for example, let's say you put $10,000 inside of the bank. This is something cool that a bank could do, and I love it. I love it. So when you put in your 10,000, a bank could take your 10,000 and multiply your 10,000 by 10. So from your 10,000, they can loan out 100,000 because they only have to have on hand 1/10 of what they have loaned out. How amazing is that, right? So let's say in this fictional world that they give you a 4%, right? They're going to loan it out to somebody wanting to get a mortgage, right? 5%. They might do 5%. Let's say, they want to do 15 years or whatever. I know now it's a lot lower at 2 or 3, but work with me in this hypothetical world, right? Then somebody wants to buy a car, right? So they're going to loan out, portions of that money that you put in again. They're going to loan it out at 6%, right? Somebody wants to remodel their house. They don't loan that out, right? Somebody wants to do debt consolidation. They're going to loan that out, right? So you looking at it, you're like, what's the difference between these interest rates? You're like, with the the home mortgage and what they paying me, it's only 1%. The car, 2%, and so on and so forth. You thinking, it's like 20%. No, it's even more than that. Why is it more than that? Because we only thinking about the 10,000. They multiplied that 10 times. And let me tell you something else. When a bank gives somebody a loan, what do? They don't give. Sometimes they give you a check, but mostly what do? They say, okay, I'll put the money in your account. Once that money hits your account, it becomes a deposit all over again. Then they can multiply that and loan that out. Why am I telling you this? Why is that important? Is because we want to do this. Take the bank out of the middle of these transactions and put your infinite banking account in the middle of this transaction. Put your life insurance policy in that. So when you're putting your 10,000 in, you want to be able to loan it out to buy a car. Loan it out, to do some remodeling. Loan it to yourself. Loan it to your family. Loan it to your friends. Loan it out and make interest on it. Because that's the only way they're going to make money. If you're a professional bank, you'll charge interest, right? And you're paying interest. I know you're paying interest on your credit cards. So again, everybody else is charging interest. You should charge interest as well. That's how you get to control your money. That's how you get to grow your money. Absolutely, Victor. That's how we become the lender, right? We become the lender. You could become the lender and the borrower, or you can just become the lender, right? So this is just a quick scenario. So a lot of people, this is a scenario with buying cars, right? This is a quick scenario. And I want to ask you all, like, how many cars have you had over your lifetime? How many, what you got? Put the numbers in the chat. How many cars have you had in your lifetime? 1, 2, 3. I mean, you think what? Most people have been driving since they're like 16, let me see, driving since they're 16. The old beater car you had in high school, but you love, smelled like smoke. You had to keep antifreeze in the trunk. That car from there all the way to the car that you're driving currently, right? So, all right, we got some numbers. We got 5 all the way to 35. Okay, we got 4. Okay, so. All right, let's go here. Let's go here. All right. So let's just say, for example, your premiums every year is like $10,000. Again, this is just a scenario. Policies can be created toward whatever your situation is and whatever your goals are, right? But the first rule of infinite banking is to pay yourself first. What did we just say? We just went over a scenario and we said all banks get their money from deposits. So now you are a banker, you creating your own bank. You have to start with those deposits. You can't start loaning out what you don't have. You can't start the process without those deposits, okay? So that's the first thing, $10,000 in deposits, right? Right. And this is just a timeline over like 7 years. But as you can see, in year 3, person's like, you know what? I want to purchase a car. So at that time, let's look at the column that says cash value. So we go down to year 3. So they have a total of 18,000 in their cash value. It was like, okay, I'm not going to take it all. I'm just going to borrow out 15,000. And I'm going to start making myself payments, right? I'm going to pay myself back over 5 years, right? We can agree, most car loans are like 5 years now, like 4 to 5 years. So they're going to do that, right? And we're going to get to the second rule of infinite banking, as you can see, which is pay yourself interest. Pay yourself interest. All right, pay yourself interest. Right? Because we can tell, right? We can tell. They only borrow 15 out. They put in a lot more. Cool. So let's just do the numbers, right? Let's take a look at this. So over these 7 years, they put in $10,000 per year. So 10 times 7, that's 70,000. So 70,000 just in deposits. But then they paid themselves back $3,600 a year over 5 years, right? So that's $18,000. So they borrowed out 15, they put back 18,000. right? They paid themselves interest. So they put in a total of $88,000, over this time, right? That's what the numbers look like, right? But let's subtract the 15,000. So because they didn't put in an additional 15, they just paid back 15, right? They just paid back 15. So that means really over the 7 years, they only put in really 73,000, right? They only put in 73,000. So out of the 73,000 total that they put in, they have $65,000 available back in their cash value that they can use again. That's 90% of the money that they put in, they have available to use again. And they earn interest. They earn interest on it just being in the cash value with the policy, and they paid themselves interest. But let me ask you this. So I had people that had 10 cars, 12 cars, 35 cars. So let me ask you guys, how many of those cars you have left? No, don't even answer that one. I'll give you an easy one. How much money and interest did you make on those cars that you bought over your lifetime? How much interest did you make? Somebody tell me. Okay. I got none. What else we got? We got zero. What else? How much interest did you make on all those loans, all those saving and dropping all my money? How much interest did you make? Okay. We paid interest. There you go. We got zero, zero, zero. So let's just look at this scenario right here. So in this 7-year scenario, right? 7-year scenario. This person has all their cash value back in their policy, right? First of all, they have a death benefit of over 600,000 to take care of their legacy for their heirs and everybody they leave behind. They have paid themselves back all the money that they borrowed, plus they receive interest, and they still have the car. Anybody else? Anybody else still have that car? I mean, we got some people that said they had about 35 cars. You still have those cars today? You still have you got the money back from all the cars that you spent? Only 4. That's good. Hey, it's better than most people. But do you have the cars and the money and the interest you paid on all those cars? Anybody have that? That trifecta? And this is how you can do it. Infinite banking. It's a new way of thinking. It's a new way of doing business. And it's a process. And this is the part of the presentation where I stress infinite banking is not a product. It's a process. A lot of people get caught up in, okay, is this company, is this? It's not about that. If you're not using your infinite banking account, how it's supposed to be used, you'll never see those rewards. If you're not paying yourself first, that's why we go back and we say, who are you? Are you a saver? Are you a spender? How do I need to get myself together so I can progress and grow? What am I? Am I a saver? Am I a spender? You have to ask yourself that. You have to be honest with yourself. Okay. Rule number 2, pay yourself interest. Think about all the interest you've been paying. You pay the credit card company's interest. You pay the auto loan people interest. Heck, I pay the student loan people interest. You need to pay yourself interest when you're using this money. And when you're loaning it out to other people, they need to pay you interest, whether friend or foe. Because that's how your bank is going to run efficiently. You have to recapture all of that money. A lot of people want to do this and never pay themselves back. They just want to use the cash value and things like that. And you can do that as long as you keep paying your premiums. You can do that. But that's not how this thing is set up. We want this thing to thrive, right? We want you to be so in tune to the process. Now you're teaching your siblings, you're teaching your children. My friend told me something today and it was so profound. And he was telling me some quote, and it basically went like this. He said, when I was young, I taught my kids how to make money. My kids go out, they make money, they have a strong work ethic, but I failed. Do you know why I failed? Because I never taught them what to do with it once they made it. And this is a solution to that. It's not only just about making money, it's about what you're doing with it. How can you keep it? How can you protect it? How can you grow it? We're only giving people and we're only learning half of the story, but it's the entire process that makes us successful. Absolutely. Absolutely. That compound interest is necessary for wealth. Absolutely. So like I said, again, this banking is a process, not a product, right? Okay, yeah. So we get our premiums in, loans out, you know, loans out, repayments back in, loans out, repayments back in, constantly money going in and out, in and out, in and out, in and out, in and out. So during this time, I'm gonna take some questions. So please, if you have any questions, put them in the chat. And this is my contact information. I'm gonna drop it one more time in the chat area. And I'm also gonna say this. I'm not gonna forget about this. We recession proof, right? We recession proof family. We all about entrepreneurship. Why do I say that? Some people say, look, man, it sounds great. I might not want to do all the training that you did, but I want to help people out. I want to bring people toward you, and I want to make some money. That's no problem. If you want to be a referral agent, that's no problem. Reach out to me. Let me know. I'll get you set up. And when people come to me, and when people come to me and they get a policy, you get a part of that commission. That's no problem. We recession proof. That's what we do. Multiple streams. That can be a stream for you. All right. So please reach out to me. No problem. So Victor, yes. Victor says run your business expenses through your policy, property tax, everything. Absolutely. I know people that specifically run, they have specific policies set up just for property tax, right? They put their money in there. You're like, why would you do that? Again, think about it. The cash value is going to be growing at a guaranteed interest rate. Um, right now, the interest rate is on average like 4%. It's on average like 4%. So, so it's going to grow automatically as you put money in that cash value. So then you take it out. I mean, this is something that a lot of people do. Um, I'll get you a question in 1 second, Barbara. But for instance, when Victor was talking about property taxes, what a lot of people do is because a lot of people have their property through LLCs, right? Which is a pass-through entity, which the money is quote unquote slides to you anyway, passes through to you anyway. So they'll take a owner withdrawal from their LLC, use that money to pay into the premium, and then when the company the LLC needs to pay property taxes, they'll borrow that money out of their policy, give it to their company, and then have their company pay themselves back with interest. So Barbara asks, do you need to be licensed in all 50 states in order to sell to anyone? No, you don't, Barbara. I would suggest that you start with the state where you're living. Well, just start with the state that you're living. And if you're like, hey, I already have 5 or 10 friends that I already know will be down for something like this, they'll be interested in this. Um, um, get licensed in their state, right? So when you're referring it, you'll be able to get a piece of that that commission from that state. So no, you don't have to be licensed in all 50 states. Are there only certain life insurance companies that provide? This is Johnny. Life insurance companies that provide this particular whole life dividend policy to stay within the infinite banking account structure. So Johnny, that's a great question, and um, there are only certain ones that work well for this process. They have to be mutual life companies, um, non direct recognition companies, and companies that me specifically. Those are my criteria. And last but not least is they have to have a track record of at least 100 years of paying dividends. The insurance companies that I work with have like 100 years of paying dividends. Oh yeah, I forgot to tell you about that as well. Dividends, right? You get paid dividends. The reason I don't like bringing up dividends is the fact that they're not guaranteed. But like I said, I work with companies that has put out a dividend every year for the last 100 years without fail. So, um, and that dividend is tax free because it's considered a return or premium. It goes right into your cash value account, and it starts gaining that interest. Chauncey, I think that's Chauncey. So are you able to MS with these accounts? I'm thinking you're talking about manufacturer spend. It's not like a credit card, but you can. I mean, if since we're recession proof and we learn how to do a lot of things with credit cards, especially on the business side of credit cards, um, on the business side of credit cards, there is a. I mean, if you wanted to take a business credit card, we've learned how to cash out our credit cards. Take a business credit card, cash it out, use that as the premium for the first year, right? Use that as a premium for the first year. Because I'll tell you this, you can, from the time that your policy is enforced to the time when you can borrow out that cash value, it'll only take you 2 weeks to like 30 days to be able to use that money again. So if you want to take that money out, and use it to do something, it'll only take like 2 weeks to 30 days to be able to do that. Right. So it's some ways that you can get creative with that. Because again, we're learning how to do the credit cards, taking things off our credit reports, being able to use all of these financial tools to our benefit. Um, All right, Barbara, is your company associated with Denzel Rodriguez? No, I am not associated with Denzel Rodriguez. Um, but I know exactly who he is. I really enjoyed his velocity banking videos. He's really great at that. We differ a little bit on how we put together our infinite banking policies, just because the way we do is we're more on the conservative side. A lot of people, they like to set it up in a way that looks really good, but long term, that policy pose a lot of risks. And again, as we were talking throughout this thing, we about guarantees, 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 right? So we don't want to look good for 3 years, but we worry like 10 years from that. This is something we're trying to make a lifestyle, not just something to look good initially. Can you trade stocks with them? what you can do is when you put your money in your account, again, oh, I forgot to tell you about this. Again, even when you borrow money out of your infinite banking account, it'll still grow as if um, as if you never took the money out. But you only get access to that new money, that new interest as you're paying these loans back. So that's why it's important for you to pay these loans back. Why did I say that? I said that to say that you can take that cash value out of, you can withdraw that cash value, take a loan against that cash value, and then start trading in the stock market. And Victor, absolutely. Victor says front load. Absolutely. So what you can do is if you say, look, I don't want a high premium, but this year, let's say I want a premium of $5,000 a year, but this year I want to be able to throw in 10 on my policy. So my cash value will be a little higher. And then that compounding starts on that higher number instead of the 5 or the percentage of the 5 that's able to go toward the cash value. Absolutely. I did that myself. I absolutely did that myself. I took the money from another business that I had, and I used that to pay my premium so I could front load it. So I front loaded it 20,000 my first year, but my annual premium is only 6,000, right? But but the higher percentage of the cash value I was able to put in that account, my account starts growing. The compounding starts growing from that point. So let's say you put 60,000 from a business card, then open another account and put another 60 in that account. So you have 2 accounts with 60 each. How fast can come back? Pay the card. Okay, so the compound interest is compounded monthly, right? It's compounded monthly. And when you can put down 60,000, but that's not going to be the exact amount that's going to be inside your cash value, right? Because this is a product that you're paying for. So, let's say if you put down 60,000, let's say you have, depending upon again how your thing is structured, your policy is structured, you can probably have access to like 30,000, right? But as still, if you put down 60,000, you're gonna have a policy worth $1 million plus. So if anything happens to you, you know, you'll be fine. So I mean, all of your heirs and stuff would be fine. Would he need to qualify for it? Yes, ma'am. Thank you for bringing it up, Barbara. Absolutely. So it's not a situation where you can just put in whatever amount of money that you want. You will have to qualify. You would have to qualify for that amount of life insurance. So how life insurance works is they take everything into account, right? And this is why it's so important for people in recession proof, because we're learning about things about people's credit scores and credit profiles and stuff like that. It's important because when you're going for a policy, a life insurance policy, it's your health, your current health, your travel habits, it's your credit score, it's your employment, what you have coming in, because you can't tell me that, you can't say, okay, I want to go out and buy a $3 million policy, but you've been making like 50,000 a year your whole life. Like, it doesn't compute. Like, they definitely have metrics that they use in order to calculate how much that you can get, how much you can get based on those different factors, right? So on life insurance side, what are the Johnny? Okay, cool. Okay. Yeah. So anything else? Anything else? Any more questions? Again, like I said, reach out to me if you have a personal question, personal to you, that you want to say, hey, this is kind of a different type of situation. I kind of have a nuance situation. Please reach out to me. Again, my information is on the screen, as well as I dropped it in the chat. I am the best through email. And if you're going to use my phone, please text me. I can do text. I really prefer text. So please reach out to me. Recession Proof Family, I appreciate you all reaching out. I appreciate you all letting me know what's going on. D Miller, send that, email me that, and we'll get into a conversation about that. D Miller, email me, and we're gonna set up a time that we can speak. We can have consultations. You know, everybody. I want to offer that to everybody on the call. Reach out to me, email me, and everybody's going to get a 30-minute consultation. We're going to set up a time. You're interested in this, you're interested in learning more and seeing how, you can secure your future, your legacy, and the legacy of your kids, because that's another thing. You can set up a policy like this for your kids at 30 days old. And I was talking to you all about that on our call the other day, and I was saying the most impactful thing about that is I'm not even securing, like, I'm not securing my legacy through that. I'm securing my my son's legacy for my grandkids. Think about that. And when you deal with whole life, the younger you get the policy, the cheaper it will be for the rest of your life. So I can get a policy today for my kids, and they will pay the same thing for the rest of their life. And then when my grandkids are born, why do you think other cultures, the first thing the grandparents do is get an insurance policy out on them? Because of this reason. And you do whole life, when the coverage is for? Your entire life, your whole life. So I can get a policy on my son for like $100. That might be, when he's of age, is worth $500,000 to $1,000,000. But as he keeps growing and his cash value keeps growing, that number keeps bumping up. I can secure that today. And when he's 18 and he goes, hey, Dad, I want a car. Or, Dad, I want to start a business, right? I didn't say college. I said start a business. I want to start a business. I go, okay, how much money you need? You know where I'm getting that from? That policy. Why do you think for certain people's wedding, they don't have to pay for their wedding? They can have an elaborate wedding. Where do you think they're getting the money from? They're pulling it from these policies that they've had on them since they were little kids. Why do you think for people's wedding gifts, they get a down payment for their house? Where do you think this money is coming from? They've been putting it away their entire life, plus having the coverage. If something happens to them, they're covered. And then once they get married, you know what they do? They go, here's another gift. Here's this policy that I've been paying $100 on since you were 30 days old. That's worth $500,000. So if anything happens to you, your family is going to be covered. Absolutely. This is what the top 1% does. Why do you think they have so much insurance? Because you can insure yourself for more than what you have. So when you die, not if, but when you die, your next generation is better off than what they are currently with you alive. Not only do they get to pay off all of your assets with that money, with the access money, they can do whatever they want. But anyway, we can get into a more in-depth discussion. If you guys want to do a part 2 where I can get into how you can use this for your business, how you can use this for your kids, how you can use this for a retirement plan, depending upon how you want to use it in a lot of different areas, and give examples and things like that. reach out to me. Let me know. I'm not going to say put it in the chat. I'm going to have you reach out to me. You let me know what you want from me. How can I help you? How can we work together to change the trajectory of our family, of our friends' family, of the generations that we'll never get to see? So thank you again. This is Ronald Madlock from MF Financial. I've enjoyed speaking with my Recession Proof family tonight. I look forward to speaking with you all again. Please reach out to me, and you all have a great rest of your evening. Have a blessed week, and go out there and grind. Let's get it.